So let's talk about why JP Morgan and Goldman Sachs think Twitter is a steal right now. Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting with Twitter is that JP Morgan and Goldman Sachs both calculated nearly the same exact value for Twitter. It's almost as if they were talking to each other. Now, in the case of JP Morgan and Goldman Sachs, they were advisors to Twitter. So this is Andrew Stotz of the Valuation Masterclass. Let's get started. Before we do, though, remember this is for information purposes only, and it's not investment advice or a recommendation. So here we can see the share price of Twitter over time. And I've just gone through a little bit of a chronology. Elon Musk on the 31st of January started accumulating Twitter shares of this year. He announced a 9.2% stake, and the share price rose 27% that day. That was on April 4th. Twitter invited Musk on the board. Musk accepted, but after realizing on 9th of April that being on the board would stop him from going beyond a 14.9% stake, Musk refused. Then on April 14th, Musk offered to buy Twitter for $43 billion or $54.2 dollars per share. The board saw it as a hostile takeover. Now on 15th of April, Twitter's board announced a poison pill strategy to block Musk takeover. On the 20th, the share price was at 47, and Musk said he secured $13 billion in loans and debt for Twitter, and $6.25 billion bank loans and $20 billion cash, both coming from Musk, Elon Musk, and $7.1 billion in equity from 19 independent investors. On the 24th, news reported that Twitter was in final negotiations to accept Musk's offer, and the deal was expected the next day. So on the 25th of April, when the share price was $50, Twitter's shares rose by 5%. Twitter's board accepted the offer for $44 billion and that Twitter would become a private company once the transaction is completed sometime in 2022. It would delist from the stock market, and Elon Musk would own 100%. Now, on May 11th, the share price was 46, and there was news reported that the SEC and the Federal Trade Commission had opened investigations into events leading to the acquisition. On the 12th of May, the share price went down to 45. Twitter CEO Parag Agrawal dismissed Twitter general manager and revenue product lead, both Kayvon and Bruce here in this case. So he started to take action. And then on May 13th, the share price was down at 41, and Musk said the deal was on hold following a report that 5% of Twitter's active users were spam accounts, causing Twitter's share price to drop by 10%. Musk later clarified that he remained committed to the acquisition, and the CEO of Twitter, Agrawal, stated that he expected the deal to close. Today, as I write this on May 20th, the share price is now down to $37. So let's go into Twitter's Schedule 14A from SEC.gov and take a look. It's publicly available, and we can dig into it. But before we do that, why not go to the website of Twitter itself and dig through it? So here I dug through it, and I found that what we can see here is the monetizable daily active users. And this is the big number that they look for. Now, Twitter's users, they've got about 229 users, which is up 15.9% year on year. That's as of first quarter this year. And basically, almost all of them are international. Only 40 million of them are in the US. So Twitter is an international platform. The next thing we can do is look at revenue by geography. And what we can see here is that the revenue is most coming out of the US. So though 80% of users are international, they only contributed about 44% of revenue. So any revenue the company's getting is coming mainly from the US. 55%. And the US is growing quickly. The revenue is growing at 20.7% as of first quarter 2022. Let's look at it by services. And what we can see here is advertising services and subscription services. And almost all revenue is coming from advertising. So let's go into JP Morgan. Previously, I looked at Goldman Sachs. So let's look at what JP Morgan said. Twitter retained JP Morgan as its financial advisor in connection with the proposed merger. In other words, JP Morgan is going to give its professional opinion of whether this deal is worth it for the Twitter board to recommend to Twitter shareholders. And at the meeting of the Twitter board on April 25th, 2022, JP Morgan rendered its oral opinion to the board. And the consideration to be paid to Twitter's common shareholders is what they were talking about. And they said that it was fair from a financial point of view to the stockholders. At that time, the share price was 51.7. So JP Morgan used 3 different methods to calculate the fair value of Twitter: public trading multiples, selected transaction multiples, and discounted cash flow. So let's go into the public traded multiples. They considered sufficiently similar companies to Twitter, and they applied the firm value to EBITDA. So here we can see the multiples of Alphabet, Meta, Pinterest, and Snap. This is a similar table that was done by Goldman Sachs, just looking at the, in this case, forecasted multiples. Now, what they did is they said basically that the adjusted EBITDA multiple reference range for Twitter was 15 to 17.5 times. They applied this to the estimated EBITDA. So basically they applied it to the profit. EBITDA is a form of profit for the year ending 2023. So they didn't look at 2022. They looked at 2023. But this is the key part, and I'm just going to highlight it here, that it's so significant that I really want to highlight it, is provided by Twitter management. That's the key. It's Twitter's management that basically provided this. So I just messed up my computer here. Hold on. Okay. So now, Goldman Sachs and both JP Morgan and Goldman Sachs basically say, we didn't forecast the profits of this company. All we did is took the profits that were given to us by Twitter, and we then did a valuation of that. So let's look at this in a table. What we can see is the value based on public trading EV to EBITDA multiples. So what you want to look at here is the average. I'm going to calculate the average. Everybody always gives a range, but let's just take an average. And we can say that the average EV to EBITDA multiple was 16 times. And that would get the company's average price or value to $54. Now, in the case of Goldman Sachs, they used a similar, as you can see, a 16-time EV to EBITDA. They mentioned the same thing there, but they didn't put in a price or a value estimate at Goldman Sachs based upon this methodology. So the first one, their range is about 49 to 58, and Goldman Sachs says it's rather expensive. So let's now look at the second method, selected transaction multiples. So they identified, and it's pretty much the same table that they produced, that JP Morgan and Goldman Sachs both produced the same table. And we can see these are really high multiples, 33 times, so 47 times, 37 times. So this is firm value relative to long-term adjusted, last 12 months adjusted EBITDA. But it's pretty high multiples compared to where things are trading. So the reference range that they came up with was 28 times to 36 times multiple. And they applied that reference range to Twitter's adjusted EBITDA, which excludes a one-time litigation charge of about $766 million, to produce a range between 50 and 63.4%. Now, here we can see Goldman Sachs basically came up with a somewhat similar analysis. They had a 28 times lower range and a 36 times upper range. So they both basically have the exact same numbers. Now, they're supposed to be independent financial advisors, but they're coming up with almost identical numbers. So here we can see the firm value divided by the adjusted EBITDA over the last 12 months. And you can see that number of 32, but that's going to be multiplied times an adjusted EBITDA. And the result of that is a price that comes in at a value that comes in at about $57. And that is about 57 also for Goldman Sachs. There's almost no difference between these two. They just use the same table and pretty much the same numbers provided by Twitter, which makes you ask the question, why did Twitter have two advisors on this when they both came up with pretty much the same thing? Kind of a waste of money. So here we can see JP Morgan's ranges and Goldman Sachs's ranges. Now, before I show you my valuation of Twitter, if you want to learn how to value companies like this, check out my 6-week online valuation masterclass bootcamp. The next class starts on July 25th. You'll learn practical stock valuation skills and apply them like this to actual companies. You'll access the tools, tips, and tricks that I've used to become a #1 analyst. And you'll join a group of inspiring, like-minded financial professionals. And you'll get a job or a better job through my network of thousands of financial industry leaders. Up until July 10th, you can save $700. Just scan this QR code or go to valuationmasterclass.com/bootcamp. So let's look at the discounted cash flow analysis next. Remember, if you have any questions, feel free to put them into the chat and I'll do my best to try to answer them. So first, you got to forecast the free cash flows and determine the exit multiple for terminal growth rate. Here we can see that again, JP Morgan says that they use the financial projections prepared by Twitter's management. So they're putting the responsibility onto Twitter's management. And then they said that the values for Twitter by applying a terminal growth rate ranging from 6 to 7% to the unlevered free cash flows of Twitter at the end of the fiscal year. Now, the unlevered free cash flows, they ended up discounting at a range between 10.25 and 11.25. So here we can see the assumptions related to terminal growth, and we can see both JP Morgan and Goldman Sachs have an average terminal growth of about 6.5 and about 7.3. Now, I'll just highlight that I did a calculation a long time ago, and that was taking the growth in the global GDP, and that was by OECD numbers over a 50-year period. And what I found was that global GDP was growing at about 6%. And if global GDP is growing at about 6%, then I would say going forward, it's probably going to even come down a bit. Let's say 5%. So to have a company growing at a terminal growth rate more than that 5% would mean that that individual company would eventually grow to be larger than the overall economy, which is a tautology. It can't be, because that company is a component of the overall economy. And that's why I think that the assumptions here on the terminal growth rate seem to me to be very, very high. We can see up to 9%, up to 7%. I think these numbers are potentially inflating the valuation. So Twitter's net cash totals about 1.3 or 1.4 billion US dollars. And so what they've done is add back that cash, and they've come up with, from a discounted cash flow basis, 36.5 to 57.6 range. And that means we can see that range is there. And then here we can see roughly the same. Now, we can see also that at times they're going to come up with a different width of this range. But overall, the issue that we face is that they're coming up with pretty much almost identical valuations. Now, there has been an issue that's come up about false or spam accounts. And in the discussion, the company said there are a number of false or spam accounts in existence on our platform. We have performed an internal review of a sample of accounts and estimate that the average of false or spam accounts during the first quarter of 2022 represented fewer than 5% of our monetizable daily average users during the quarter. In making this determination, we applied significant judgment, so our estimation of false or spam accounts may not accurately represent the actual number, and the actual number could be higher than we have estimated. So let's just take a moment and talk about this, because this is a significant factor right now. This is the issue that Elon Musk is holding up the deal based upon. Now, already, if you have Twitter on your phone, you can check the number of spam or bot accounts. I just recently did it, and I came up with about 30% of mine are spam or bot accounts. That's a massive number. Now, Twitter's going to say external sources like that, external calculations aren't ever going to be able to really capture the number. But what you also see is that Twitter has been declaring 5% every single year for a long time. And the point here is that maybe they've been understating it for a long time. And that's what Elon Musk thinks. Now, the question is, did Elon Musk get into this deal just to show that they're miscalculating it? Because if he's relying on this 5% estimate, and they say it could be higher in their numbers, so they do state that it could be higher. But if the number actually comes in at 20% or 30% or 40% bots and spam accounts, then all of a sudden, Elon Musk has an ability to say to them, hey, you've misled me with the information, therefore the deal's off. And if that's the case, he could potentially walk away with $1 billion, as Twitter has to pay if the deal gets called off by them, and he would have to pay if the deal. Now, imagine that he can't prove that they're more than 5%, but he knows that they are. But if he can't prove it, then what's going to happen is that he's going to be forced to either buy the company or walk away. If he walks away, he has to put up $1 billion. So it's a little bit of a difficult situation right now. So let's go back into the presentation and look at it a little bit more. So the question I want to ask you is, do you want to know how I valued Twitter? Well, you can check out my previous video where I open my value model of Twitter. You can just scan this QR code to learn more, or just go to YouTube and subscribe to Valuation Masterclass. So let's take a deeper dive into the Twitter's fundamentals. In fact, I was so interested in this that last night I couldn't sleep. I mean, I slept at about 8:30 at night, and I woke up this morning at about 2 a.m. and I thought, I want to go through Twitter's financial statements. So here's what I got. First of all, I decided that I would look at Twitter, Facebook, Google, and Snapchat. And here we just look at the company's EBIT. And what we can see is that Twitter is basically EBIT break even, and Snap is not there yet. That's compared to Facebook and Google, which are making huge amounts, billions of dollars of earnings before interest and taxes. So you can see that Twitter's operating business has never really been profitable. Well, let's look at the underlying profit at the bottom of the P&L, and we can see that, in fact, Twitter only made money in 2018 and 2019. And in 2018, they had some income tax benefit that they realized from a valuation allowance related to Brazil. And then in 2019, they had 1.2 billion of income tax benefit that they realized that was related to the establishment of deferred tax assets from intra-entity transfers of intangible assets. So you could argue that these two profitable years actually may not be, they definitely weren't operating profitable, but at the bottom line, they were only made profitable by the taxes. Now let's look at Twitter's gross profit margin. Here you can see the gross profit margin of Twitter is strong. Facebook is gross profit margin champion. They've got an 80% gross margin champion level, and Twitter is second place. So in fact, from a revenue and a cost to produce the product and all that, Twitter's in good shape. So the core business is solid, but it is the EBIT margin where they're getting killed. So Facebook is EBIT margin champion also, and Google is in second place, and then eventually Twitter. Now, Twitter is at an EBIT margin right now of in 2021 of about 5%. The average of companies around the world is about 10%. And here you can see in the tech space, it's very high at 30 to 40%. So again, the core business is solid, but the EBIT margin is the problem. Now let's look at the net margin. Here we can look at the final profit relative to revenue. Snap has never made a profit. Twitter only made it in 2018 and 2019 because of the tax adjustments that I mentioned. But otherwise, the net profit margin in 2021 was negative 4.4. Ouch. Facebook and Google are killing it as far as net profit margin. These are some of the most profitable companies in the world. In fact, it makes me think that I'm paying them too much. Every time I do Facebook ads, I get nothing. So Let's look at the free cash flow to the firm next. I've done this calculation to try to understand, and we can see that there's negative free cash flow to the firm for both Twitter and Snap, and massively positive for Facebook and Google. So if you're going to value the company based upon a discounted cash flow and you're going to use free cash flow to the firm, you're going to have to forecast that Twitter is going to be turning around and making a positive free cash flow in the future, but not right now. So it's a turnaround story. Now, turnaround stories are much higher risk than a typical story. So finally, I did a calculation of the return on invested capital. Snap is just bleeding. Twitter's return to investors is tiny. They've never really gotten anything out of it. And Facebook and Google are massive value generators, with them both having return on invested capital of up to 60%. It's out of control how profitable these guys are, particularly considering the amount of capital that's needed to run their businesses, which isn't a huge amount. Now, since the EBIT is the problem that we saw, let's break down the expenses. The financial statement gives us some information that we can find, and we can see here that gross profit margin is strong, but Twitter's operating costs are massive, and they're eating up any of the profit opportunity. So you can see that sales and marketing account for, in 2022, first quarter of this year, counts for 25% of total revenue. That is way too high. And general and administration expenses at 12.5 is also still very high. If you combine these two expenses that come right after the gross profit, you're talking about 37.5%. They're both growing at 27%. This is the main problem that I see when it comes to valuing Twitter and really turning Twitter around. They have to cut these costs. So let's look at the revenue. The revenue of Twitter, we can see, is basically Twitter, like Snap, has tiny revenue compared to giants like Google and Facebook. And basically, Twitter and Snap are getting close to both at about $5 billion. Now, the question I have for you is, would you buy Twitter at a $52 share price? So finally, to wrap this up, I want to tell you that JP Morgan right now and Goldman Sachs think Twitter is a steal. What do you think? Well, why do I say that they think it's a steal? Well, you have two investment banks, the two best in the world. Both came up with a value that values Twitter at, let's say, $50 to $60 per share. But Twitter is now trading at $37 per share. That means it's a steal. So my question to you is, would you buy Twitter right now at $37 per share? Let me get into some of the questions that we've got here. So first question comes from Papa Benny. P. Pear. Wait a minute. Why Twitter's hired these two companies to value? Yeah, it's not really clear to me why sometimes you're required to have two different valuations, but if that was the objective, they didn't get two different valuations. They just got the same thing. It could also be that they are their advisor and have been, and so they're going to ask them for their advice. All right, next, Ben Hur says, at this point in time, do you think it's scary for investors to put their money in Twitter? Well, if you believe that the two best investment banks in the world value Twitter at $50 to $60 per share and the share price is trading at 37, then you would say that now is a good time to buy. I wonder if they would have a different number if they knew the share price was going to fall. This is something called recency bias, where we see that people that are valuing companies tend to tie their valuation to the share price. Let's look at the next question. Watson says, why is GM, the gross margin, rather expensive using the first method? That's a good question. And Goldman Sachs, I believe, is what you're asking, is because the multiples are about the same. So it has something to do with the EBITDA. And I'd have to go back and dig through that to figure that one out. But for right now, I'll continue on. And Henry says, what do you think is the reason for the sudden interest in Twitter by Elon Musk? Well, first of all, he uses the platform, so he obviously likes the product. Now, this is where I'm a little bit wondering. Was he just playing a game? Was Elon Musk just playing a game with Twitter? And he knew all along. I mean, he knew all along that it wasn't 5% bots. It was much more than 5% bots and spam. But yet he's saying he's relying on the company's information. So maybe he just went in this to get Twitter kind of caught in a catch-22. They've been announcing 5%, but if the actual number comes in at 20%, then they've been misleading the investing public for a long time, and he can back out of the deal. The share price gets tanked, and he's out. Now, Amonrat says, between Goldman Sachs and JP Morgan, which one is more reliable? I think that's difficult to say. I would say that they both have some reliability that should be very, very high. So why does a tech company like Twitter have a lot of operating costs? Well, a lot of that is salaries related to the management of the company. The salaries related to the development of the Twitter product, those salaries basically are in the cost of sales and services. But these costs are related to the salaries of the staff that are managing the company and all of the other costs that they have of running this business, and also the marketing costs in there. So Lingon says, I agree 100%. So that wraps up my my work on Twitter. I feel like there's a lot of questions that I have, but let me just end by saying, would you buy Twitter today at $37 a share? Let me know in the comments below.